Hello, this is Dave, and welcome to Equity Story. I'm here with the amazing Claude, and this is just a general share advice and not personal advice. Now, Claude, before we start, let's talk about the general market, the Dow, and a big sort of sell-off on Friday night, and because the job numbers were surprisingly good. So the Fed is so far hasn't quite put the inflation genie back in the bottle, has it?
No, and I mean, we're not even going to know for a while whether, like, when that's going to happen, because it doesn't automatically mean just because inflation goes down a little bit, that doesn't mean that it's going to be like a perfect up and then down journey. It's just going to take probably a year or two at a minimum for people not to be worried about inflation, which is understandable. But of course, as that worry sheds, that's when you'll get the markets rising. The markets will rise at not once there's no worries, but throughout the process of people going from worried to less worried.
Tell me, when we look at US debt, and often I think you look at this, which is interesting. There's I'll bring the US old debt clock up, right? So they're 31 trillion, and it's I think they put on $1 trillion in debt in the last 8 months. About 2 years ago, Yellen was asked about US debt, and she said, "Oh, it's not an issue because we're only paying 0.25% interest on the debt." Now it's up to 4.5%. I mean, when is something going to have to give?
Only if the US loses its place in the world. They're in a charmed position whereby when things get iffy, the US dollar rises in value, which puts them in a position to, effectively expand the amount of US dollars without doing themselves any damage in terms of, or they would affect the valuation of the US dollar, but it doesn't matter because it's just a stabilizing force for the world if the US dollar has been strengthening. So yeah, that's a lucky position for US to be in. The economic world leaders. So they basically are the ones that I'd be least worried about in many ways. Of course, there are things that could destabilize the US, which would be namely if it lost its position as a world leader in terms of military and economy, and I guess even like culturally, financially, all of those aspects play into its power, and that would be the main threat to them, I reckon.
It's incredible, isn't it? You look at this, the average debt per citizen is 93,000. It's a crazy time. So anyway, if you look at our market, I think our market's getting concerned as well that maybe this inflation is going to be harder to cope down, and the market looks like, and we're on the way down. And I would say, again, if you look at the Dow, we talk about the Dow a lot, but I think we're on the way over next October, November. Well, I think we're on the way to this 25,000, unfortunately. And then maybe that's going to be more interesting time to have a look at getting into some buys. But I've still got this market going down quite a bit more, Claude. And actually, when you look at it, it's still, I mean, it's only trading where it was.
Yeah.
It's only trading. Yeah, it's trading where it was a year and a half ago. Like, I mean, it's,
Yeah, it's also trading where it was pre-COVID. So.
Yeah, it's a big deal. I mean, and the world was a lot better place then than it is now. So common sense.
Exactly. You could see it going down.
Yeah, definitely. But I suppose our market is different, where we've got different type of companies and commodities, a lot more dividend plays. But again, you could see us coming at least down to that 6,000 level. Anyway, let's talk about some stocks. And there really was very little announcements today. AV1, which is that they have the traffic guard. They say they're up to 3.3 million recurring revenue and gradually getting sales. You're not impressed with this one, Claude. Come on, tell us.
Yeah. So look, as I was saying previously, the problem with this company is it's a subscale. It's very much a subscale business in that I think that its server hosting costs are some 80% of its actual revenue in the last year. So that's super subscale for a small software company. They've got a lot of work to do, and given that they're burning cash as they grow, that probably means they're going to run out of cash and need to raise money and that kind of thing. So yeah, for me, I would generally want to, if I was going to back a small software company, I would probably want to do one that, even if it's subscale, it's closer to being the kind of scale it needs to be to make a profit. And these guys are quite far away.
Yeah, and they've got to really scale up a lot more to get that recurring revenue looking a little bit better, haven't they?
Yeah.
Some lithium plays, CXO came up with an announcement that's a hold. ASN delivering again another resource upgrade, so looking very good on the charts, and looks like it's holding that 30 level, which is excellent. And Gal, they came in again with a pretty strong announcement. You can see the stories are actually delivering recently on some good announcements. Have actually had some fairly decent charts of late, and they've got a new nickel sulfide zone discovered. So a little bit more good news there, which is obviously helping that stock hold up reasonably well. Claude, you wanted to talk about dividend stocks.
Yeah,
exactly. Because there's not much to talk about. So dividend stocks where...
Well, just while we're on resources, have a look at AIS.
Yeah. They had an announcement as well today, didn't
they had this morning, but it went down. So I don't get that. I'm not an expert in mining companies, so I guess I don't really know, whether the market should go up and down when they put the drill results out. My interest in these guys is more just, oh wait, that's Helix. That's not them. So it's a different company. Strange. Let me see that. I don't understand what's going on there.
Oh, it's just one they've got obviously they own a part of.
Yeah, exactly. So I guess that's why it didn't really react.
Yeah.
Yeah, interesting. Anyway, so a few different interests there. The reason I'm interested in this one is because of the other people that have invested in it, basically. I think it's, yeah, I'll talk about it some other time when I'm sure, but a couple of good investors with good track records did participate in the capital raising not long ago of that one. So that's why it's like one I'm kind of interested in.
I'm interested. You know what I'm interested in? The great Claude Walker following other investors. Now,
as I said, I'm not following. I don't own shares.
I never thought you did. I never thought you did that.
Shares in it. No. I'm not doing that. But I'm interested in it because it makes me think. Well, it looks like smart money went into it at a higher price. So I wonder what's going on there. That doesn't mean I actually bought shares myself. Like that's how I approach it when I see little speculative companies. Like another one that I remember looking at it in the same way many years ago was called Antisense Therapeutics. And years ago I noticed that one just because I saw a couple of funds, like I think it was like Australian Ethical and Platinum or something, usually fairly risk averse funds that had invested in this tiny little biotech. And I thought, oh, that's interesting. Obviously beyond my understanding, but I think that was, years ago now, like maybe 2018 or whatever, like even off the left of that chart. And then like, sure enough, in due time, it became stupid. Oh no, this is a different stock, ANP, but it became very hyped after the good investors got set. So just an interesting, a different approach there.
That's all right. But it's just interesting psychology, but that the great Claude uses. Now,
well, no, it's more just like an educational point for me. I don't invest on that basis. Like I need to understand it myself, but I still sometimes think, yeah, I wonder if that one's going to go. I think about it as a bit of a trade at some point.
No, it is funny for me because it's something that I'd look at the charts and I'd look at, yeah, these guys are in it. I quite like that, right? But I know what you're like. You've got your system, you've got your belief. No one can tell you something is black if you think it's white, right? So at the end of the day, you'll look at those, you'll look at your own, you'll look at the books, you always make up your own picture, won't you?
Yeah, but it's just, I'm more likely to see what other people are doing when it's mining or biotech because it requires specialist knowledge that I don't necessarily have. So that's why I do that more for that kind of stock.
Okay, now this is what you want to talk about. There's all these dividends here, right?
Yeah, let's pull out a few interesting ones.
Right.
Look at what the high yielders
Look
are.
and these what you're talking about. There's a danger here because these are largely some really big dividend traps. So people might look at this and think, "Wow, Magellan at 23."
Yeah, Magellan, I would say, is a dividend trap because it's in severe decline.
Yeah, and you've got things like 40% grain, iron ore going down. I mean, coal, that might hold up reasonably well. I don't know.
Yeah. Australian Clinical Labs might be interesting. Obviously, that yield will go down from 14.5% trailing yield, but Australian Clinical Labs going to take a hit from a lot less COVID testing, but at the same time, that's not its entire business. So, yeah, actually, I'm going to take a closer look at that one. But no, what I wanted to talk about was like some of the like Centuria Office REIT. That's a good one to talk about, and maybe we could even look at the chart there. But essentially, I think you've got to be very careful with these office exposures because they're going to look really cheap on dividend, and they're going to look really cheap on like earnings or net asset values and stuff like that. But essentially, to me, there's probably been a huge structural change in the value of office space, and these guys still have all of their valuations, they're on a really tight yield, and the valuations are going to go down for two reasons, which is that office space is a less of a premium now because it's much easier to just have smaller offices and allow people to work from wherever they want, plus come into the office sometimes. And essentially, they've basically also got a big problem in the fact that the risk-free rate that you can get just from buying bonds is going up, obviously. So that the cost of their debt eventually goes up, and B, those rental yields no longer look so attractive. So what do? You have to put the valuation down. So yeah, just careful with these ones. You can't really trust. Like, I'm not saying they're wrong or fraudulent, but you can't really trust the historical numbers that are giving you the PE multiple or the net asset value, because they probably need updating.
So when you're looking at you're looking at the market coming down. There are going to be some good dividend stocks that are going to hold their dividend, aren't there? There's your opportunity to get into these stories.
Yeah. So the kind of dividend stocks that I generally, so basically, I think all big dividend stocks can be a bit of a risk of cutting their dividend. But the ones that I'm actually interested in are probably like lower yielding. And what I like is a distribution network. The reason distribution networks create decent dividend stocks is because usually scale becomes its own competitive advantage, with time. So, for example, in the case of, a company that's distributing truck and bus parts, you need a physical inventory of this wide range of parts, and you need to store them somewhere. But you also have to have a network, that can physically transport those parts to wherever they need to be, ideally as quickly as possible. So as you get bigger, there are economies of scale that you can access more areas and take more advantage of the inventory that you do hold. And also, it makes more sense to have a large inventory so that you can cater to all comers. But all of these things are also capital intensive. So in an inflationary environment, two things happen. First of all, such companies often struggle to fund their dividend because they need to, if they're growing, they need to fund ever increasing inventory holdings, and perhaps also expand through physical assets, which require land and, vehicles and warehouses. But on top of that, it also makes it harder for anyone in the future and more expensive for anyone in the future to ever replicate these same assets. So, that the 60 million of inventory might need to come 80 million of inventory, which requires obviously an extra 20 million from this company. But it also has put up the price of, ever replicating what they have up to like 80 million just to get the same inventory. So these periods can be periods where the stronger distributors can become even more dominant and even less likely to face competition. So, but it's also in the meantime, during a period of high inflation, it's harder for them to pay dividends. So those companies can keep on winning for very many years by having such a competitive advantage. That means that as they get bigger, they also get stronger. But at the same time, right now, in the short term with the inflationary environment, I'm cautious of these and have sort of lowered my desired buy prices, because I think in the next year or two, that's when you start to see some of these not growing their dividends or having to cut their dividends or raise capital or something just to fund the expansion. So, yeah, those ones that I have in mind are like much lower yield, like 4%. Like I'm talking about. Do you want to get the chart of Data up, Dave?
Yeah.
This is an IT distributor, and I'm looking at it, trying to buy it at a slightly lower price than where it is at the moment. But it's also got a lot of good points to it. For example, aligned long-serving leadership team, including the founders, and obviously the digitization of a lot of workforces creates a bit of tailwind. So I'm looking at around $8.71 to $9.63 as my like desired buy price range for Data, which is obviously not that far below where it is. So in any current sell-off, it's one of the ones that I might look to top up on, and I already have quite a holding of that.
And Data, it's giving quite a yummy dividend where it is at the moment, isn't it? At 4.9%. That's not too bad.
Yeah, that's what the trailing yield is. Although I would, just caution with something like Data with the dynamic that I've just said. It's possible that, I think that to be very, it is around at least 4.9%. I would have thought the forward yield would be, but just keep in mind it could be a bit less.
Right, but there's one, Claude. We're going to get the sell-off October, November, right? This is what you're saying. If it came down somewhere near $8, you'd be getting
even above $8, I'd probably have a nibble, just because that the likely yield does get reasonably attractive then. I do think over the long term they will grow their yield, right? That's the real reason I'm interested in these kind of stocks, is just because it's real simple. If you have a distributor that is going to get stronger as it gets bigger, and also there's some tailwind that means it's going to get bigger, then it's hopefully going to get stronger. And as it gets stronger, it becomes more monopolistic or oligopolistic, which means that gradually sustainable margins can increase a little bit.
Brilliant. Now, another one you wanted to have a look at what was SNL, Supply Network. So I'm leaving this on the monthly, right? So tell us a little bit about this story, Claude.
So this is the truck and bus parts distributor I was talking about. Look, I'm hoping that it's a little bit inversely correlated with the economy. In harder times, you would probably replace your buses and trucks a little less. And then that means you're going to have older trucks and buses, which hopefully means more part replacement. So that's a theory, not guaranteed to be true, about why this might be a resilient business. Then in terms of, whether it grows, well, I guess it probably just grows with population growth. So we're definitely going to be increasing immigration, and probably, I'm guessing that will be most governments' response to how do they make the economy grow. Probably just get more people in. That keeps land prices high. Everybody's happy. See what happens with that. But if so, then there should be at least a mild tailwind. So one of its competitors has been very weak for a few years. So if they're getting their act together, it might be a bit more difficult. So we'll see what happens. It's a bit above where I want to buy it as well, but another one that I own and would be interested in picking up at around $7.31 to $8 or $8.08 basically.
So they've got direct
same dynamic with inflation potentially putting pressure on them.
So the interesting thing is, good to see the directors have been acquiring shares of late, which is a good sign. It's something that you look at quite closely, don't you?
Yeah, so both Supply Network and Data have directors participating in the dividend reinvestment plan.
Yeah.
And obviously, as I've just said, like about 5 times. So sorry if I sound like a broken record, but these kind of businesses end up needing cash in an inflationary environment in order to fund increasing working capital needs. So that's why they're all like, about their dividend reinvestment plan. Data even raised capital at $10.30. So that's going to happen. It's definitely going to be I reckon, going to be a tough couple of years for these companies, but nonetheless, they really have. Look, that's a great long-term chart. You can just see what a very, very long-term journey this has been. The share price maybe didn't move much from 2013 to 2017 or whatever it is, and that could well happen again. But over the long course of time, this chart matches up with the real life story, which is that it's been a business that's like been gradually improving its competitive offering and, improving over time.
Now, this dividend isn't huge, right? Is that correct? Or
correct? Yeah.
It's 3%. But is it one that can grow? These guys grow this over time?
Yeah, absolutely. So Data, for example, pays out 100% of its earnings in dividends, right? Which is why it has a higher yield. SNL doesn't pay out that much. I think it's around 65, 70%. So as a result of that, it definitely has more room to grow its dividend without having to dilute as much. So that can be a good thing long term. But yeah, so at the moment, only about 3.2% yield or something like that. But hence why my target buy price is a little bit lower. I think we'd be looking at it closer to a 4% kind of yield in my buy range, basically.
I spoke about two dividend stocks the other day, which I think in the medium term should hold up. One is the Darrell Bay infrastructure play, DBI. They're basically the coal terminal up in Queensland, and at the moment they're coal going crazy. It could be a decent dividend play possibly for next year or 2 years. And
I'm definitely going to take a closer look at this one, Dave, because it seems like it might be a good way to get a decent amount of money reliably from this kind of coal infrastructure, but without exposing yourself to like massive downside if the coal price drops.
Yeah, from that point of view, interested. But obviously, I think in the future, maybe in 10 years from now, I don't know what they're going to be putting through the terminal. Hopefully, they'll find another commodity because coal is hopefully on the way out.
Yeah, I bet they will, though. We'll see what happens.
And then AZJ was the other one, the sort of rail terminals or the rail infrastructure. Again, with our commodities booming and strong, I mean, these guys have been giving us sort of dividend around 6%, a P of 12, again, holding up reasonably well. I mean, not the most brilliant chart. It's actually somewhere near its all-time lows at the moment, which is interesting. But again, not you'd think a pretty solid dividend, Claude, in these pretty awkward times.
Yeah, I do think it'd be fairly solid. I think probably part of the reason they've come down a bit is just they're like bond proxies. So, or behaving a little bit like bonds. So,
yeah, definitely.
That might be why they're down.
Definitely, especially now when you look at US bonds, where they're giving it over 4%, 4.5%. UK bonds giving up and up every day. There's a lot of other options out there for investors, that's for sure. It's good to see, well, not good to see, but over the weekend for oil's up. So Woodside, I just go back to these daily charts. I think Woodside and Santos, again, outperforming the market very, very strongly today. And I think they most probably will have a fairly decent week. Did you have any sort of other dividend stocks of interest ones you wanted to have a look at?
Oh, I guess while we're on the subject, I think my biggest yielding dividend stock at the moment is the one called Diverger, DVR.
Okay.
And that's on about a 5% yield, fully franked. And yeah, look, I'm not super thrilled with this company. There's a massive risk that it's going to do do some sort of big takeover or other weird empire building thing. But it's a low P ratio, about 10, dividend yield of about 5. I think with honest and competent management, it has the ability to actually grow its earnings so that like next year I'd be expecting, say, 5.5% yield maybe. And then I think it could solidly do that over time as well if they just knuckle down and focus on growing the dividend and growing the business. However, yeah, look, there's a huge risk that they do some crazy acquisition, and that's actually what happened, where you can see that dip in the chart there. There was talk of them doing a nuts acquisition, and that's why it dropped down and then came back up after they said that, you know, essentially weren't going to do it.
Is this one of these wealth management finance companies that just sort of is just buying accounting firms or?
Yeah, similar to that. So actually, it's previously called Eastern, and it's done a few divestitures lately. So it's been listed for a lot longer than that chart, but yeah, just that's when it's called Diverger, and it has a very attractive part of its business, which is essentially selling educational materials, like worksheets that tell them what to do in certain scenarios, and training materials and compliance materials and stuff. Selling those materials to AFSL holders that also rent its AFSL, and on top of that, also accountants. They have a whole business in selling all that kind of stuff for accountants as well. So very much got a sort of nice little business there that hasn't been necessarily like growing in any kind of strong way, but they have been doing okay from. And yeah, look, that's the story. There's no real magic ticket for them to get good, great, long, sustained organic growth, but nor are they really priced for it. So any growth is a bonus, and they're only paying out around 50% of their earnings. So, you know, even if they just move their dividend up to the 60% range at the top of their stated range, that would make it a 6% yield. Now, they're not showing any signs of doing that, but if they do that kind of things, you know, essentially it could be a decent stock.
Claude, I like this. I think I understand why you're looking at this, because they're very resilient. The earnings of these sort of companies, these financial planners, accounting type businesses, it's very, very. I think I'm looking here. They've got 155 different businesses on the go. It's well diversified. I can understand why you certainly like the story.
Yeah, and also look, part of the reason the share price is where it is one of the old founders who, you know, founded one of the, I think, accounting or wealth management businesses that used to be the main businesses of Diverger, which have sort of, I think, been divested. They've been kind of exiting, and they're big holders, and you know, that just creates this sort of overhang, which has like definitely kept the share price down, because yeah, that's essentially what's been happening. And so yeah, I think it is structurally cheap, and who knows how long it will take for this changing of the guard to happen in terms of the share registry. I don't know the answer to that, but if it can be well run in the meantime, I reckon, you know, shareholders will do well. Like I said, just keeps on coming back to this huge risk. The remuneration of the CEO really incentivizes stupid growth initiatives. So it's sort of problematic in the way it's sort of being run. I don't think there's like that kind of clear founder owner who's only going to act in the smartest way. There's people there that definitely going to benefit from just the random empire expansion of the business rather than actually improving the dividends, et cetera, et cetera.
Okay, so an interesting idea anyway, Claude, and that's what we're here for. On that note, listen, we'll wrap up. There's not too much today. We'll have a look at those, obviously those dividend stocks, and definitely we've got Diverger on the list. Thanks to you, Claude. On that note, I'd like to thank you very much, and have a good day. And we are live.
Yep. And of course, as a reminder, I do own shares in Diverger already, just to put that out there and remind everyone. So I'm a bit biased on this.
Okay, and tomorrow night, be there, 7 o'clock, the great Claude Walker.
Yeah, that's right. We've got Ask the Analyst tomorrow night. It should be fun.
Ask the Analyst live. All right. Thanks, guys. Thanks, Claude.
See you. Have a great day.
Bye.